The Lal Street ends higher for the second week in a row. The Nifty and the Sensex rise 1% this week. Mid-caps outperform. This week, we take stock of the big block deals seen on the Lal Street. We put the spotlight on India's jewellery sector and we'll decode the market action. Hello and welcome to another edition of Editors Roundtable. I'm Reema Tendulkar. With me, we've got Nimesh, Mangalam and we've got Mihir Vora with us in the newsroom. Hi, boys.
Hello.
Hello, how do you feel this Friday afternoon?
You feel tired after running on a treadmill. That's exactly how you feel. Why is that? Because yes, you've run, but you haven't gotten anywhere.
Yeah.
So that's exactly what happened in the markets as well. So much happened, and yet we're up by just 1% for the entire week. A lot of stocks moved. A lot of stocks moved in either direction. A lot of buyers, a lot of sellers. So much happened, and still we are here on a Friday.
But not a bad outcome, you know. Honestly, given the fact that we've rallied pretty hard, we've been outperforming. This week saw some bit of jitters from the global markets as well, at least towards the end of the week. But still, we managed to, hold on. The fact is, even if you look at our internal data, the PCR is at almost 1.4, which is not a healthy sign. 14, 15 stocks are in F&O ban, and large blocks for 20,000 crores, and still we are up 1%. So I would read it that way, that the momentum still seems to be with the bulls. Despite so much of supply coming in, we are marching ahead. And the fact is that we are ignoring a lot of global as well as local news. So I guess a bit of complacency now in the market. One needs to be watchful. But the moment, it's basically a liquidity market, so you can't complain.
So even after absorbing this kind of supply, the Nifty is up 1% this week, the mid-cap index is up 1.5%, and the small-cap index has a gain of close to about 3%. Mihir, you're also surprised, right? We've seen flows of 5,000 crore of cash in a single day. That happened on Thursday. Both the FIs and DIs purchased, but the markets have not moved up.
Absolutely. Which also shows that, there is supply coming in at higher levels. And it's no surprise. We have a host of IPOs. We have QIBs almost every day of a couple of companies. You have PE funds selling. You have promoter blocks being offered for sale. So I think at a price, supply does tend to respond to demand,
And this week it's accelerated a bit. But, I just want to put on board the HSBC note, Nimesh, that you were highlighting earlier. And they say that Indian equities are hot, undoubtedly. But after 13 out of the 15 years of gains and trading at lofty valuations, they're asking the question, what can go wrong? So they've identified 10 risks which on their own do not pose any kind of an immediate threat, but in aggregate, it could derail the rally. So they continue to stay overweight on the Indian equity markets. They're acknowledging the risks in the Indian market and the 10 risks that they've highlighted. 1, the stress for banks is increasing. 2, banks are struggling to grow deposits. Private sector capex is sluggish. There is weak and concentrated foreign investment. Unequal consumer growth. There are risks to earnings. Q1 earnings has been very, very muted. ESG and sudden changes in the regulations. Mihir, put all this together. Do you think a correction is coming? What's your own gut?
Price correction, I'm not too sure, because I think nobody wants to call the top because of liquidity. The kind of mutual fund and insurance and NPS, etc. flows that are coming in, that financialization theme continues to grow. But yes, I would be worried on a couple of fronts. One is that we've just finished the earnings season now, more or less everything is out in terms of results. And if you look at the top 100, 200 companies aggregate, the numbers are not that great. You've seen single-digit earnings growth in the Nifty. Now you can slice and dice by saying metals, non-metals and all that, but the headline number is a single-digit growth and almost 1% growth only on the Nifty earnings. And this is after probably after 3 or 4 years that we've seen such a low YOY year-on-year growth on the Nifty earnings. So that's one. Second is the US is slowing down. Now, of course, the flip is that because the US is going to slow down, we are going to see rate cuts, so you can be happy about it. But the fact is that the US is slowing down, and the largest economy in the world is not doing that great. China anyway has not been, it's been struggling for a while now. So we do have global headwinds coming in, and with the large cap earnings at least not looking that great, it's time to be a little more choosy, if not cautious.
So how are you choosing your stocks in the portfolio? Because you've just recently launched a multi-cap fund as well. I spoke to a lot of investors, including you, at the couple of conferences, and everybody seems to be a bit cautioned, right? And normally, market doesn't favor the consensus. So in that sense, how are you looking to position your portfolio?
So I read a WhatsApp forward somewhere, that fund managers are worried, advisors are cautious, but retail investors are optimistic. So that's what it looks like currently. So it's only been 4 months since we launched our fund, so not great in terms of churn, but actually in the initial portfolio we used to probably have a lot more industrials. Just 4 months ago we were very overweight on industrials and the growth names like defense, all those themes. But fortunately they ran up very sharply. Probably aided by some of the large NFOs in the manufacturing space, defense. So stocks rallied, and actually we started trimming also. So 4 months is really a short time to really trim your position, but the gains were so high that we actually trimmed positions in the industrial space and going more into some of the capital market links themes, the pharma plays, etc.
So Mir, is this going to be the trick now that as fund managers you have to be very aggressive, buying also and selling also, and like churning the portfolio every now and then is going to be the key mantra to have an alpha?
See, active, I wouldn't call it churn, I would call it active management.
Right, sure.
And for us, the churn or the buying or selling decisions come because of either price movements or change in fundamentals, right? If everything else remains same, there's been no earnings upgrade and the stock is up by 50%, then probably you want to sell it, right?
So, on these fundamental related versus price movement itself, there are so many confounding cues. When you started out, you said that US is slowing down, but now the belief is that maybe, because US is slowing down, the Fed will cut rates and that will be positive for us because that will infuse more liquidity. Similar is the case for promoters selling as well, right? One looks at promoters selling as a sign that the promoters are exiting, but a lot of them look at it as increase in free float and thereby perhaps an increase in MSCI weightage, and therefore there would be some more funds coming in. So it's that market where everything is justified to one's original benefit. How does one then maintain their rationality in a situation like that?
Absolutely. So you ultimately you got to stick to the knitting, which is study the valuations, study the growth prospects, take a bigger picture view and act. So as I said, I typically would not like to churn a stock in 4 months, but if a stock is up 60% and nothing has changed, then probably you want to trim it, right? So that's how we work.
Okay, hold that thought because we want to get your thought in also on the jewelry space. Mangalam, you've done some analysis, and this week we had big moves in Kalyan Jewellers.
Exactly. We were talking about the promoter stake selling, etc. This was the first time a PE, sold and the promoter bought in a very long time, and that explained why the stock moved higher. So I thought, let's use that as a peg to try and understand what's happening in the jewelry sector itself. So the jewelry sector in India, of course, is comprising of a lot of the others and the leader itself. The leader is Titan. We are talking about that, and we're talking about how the others have panned. So if you look at, Titan's stock price move over the last 6 months, it's actually negative versus Kalyan Jewellers at 57%, Senco at 36% as well. Last 1 year, Titan's up 17%, Kalyan Jewellers up, along with Senco, up nearly 160 to 170% as well. And you expand the time horizon, 2 years, Titan's up 48%, Kalyan Jewellers is up 650%, and from its issue price, Senco Gold is up 250%. So it's over 2 years of underperformance from the leader. What exactly is happening? Well, if you look at the thesis of the industry, not much has changed because the organized sector is still growing at 2 to 2.5 times industry, but it's the disruptors, the newer players who are growing faster due to one, lower base and getting access to a lot more capital by listing or raising funds, etc. Their store expansion through franchises, and obviously the margins improving due to operating leverage as well. The product differentiation in jewelry between two brands has reduced because of BIS, competitive intensity, price parity. Everyone's margins have compressed, and there was a huge valuation gap between Titan and the others. That has become narrow as well. So if you look at Titan's jewelry margins itself, over the last many quarters, it's come down from 14.4% to about 10%, talking about the intensity in competition in the market. And this when the revenue growth has been similar to all the other players on the huge base as well. If you look at all the other players as well, where do they stand? Titan, for the last year, trailing 12 months, revenues were close to around 44,000 crores, Kalyan closer 20,000 crores, Senco and Thangamayil between 4 and 5,000 crores. But in margins, Titan is the clear leader at 11%, and which is why it gets the maximum market cap as well at 3,20,000 crores. And with the up move that we've seen, everyone else is at 61,000 crores and below. Titan has 490 stores, Kalyan 277, Senco and Thangamayil between 59 and 165. Kalyan has actually increased its stores by a fair amount as well. So what next will happen for the jewelry sector? There is improved consumer sentiment ahead of the festive season, the cut in the budget, store expansion in India and abroad would be the key trigger for every player. design and brand positioning will be the key differentiators for Titan and the others. We need to watch out for the impact of lab-grown diamonds and how that plays out on margins. And then there are newer formats like Carrot Lane for Titan, Candere for Kalyan, etc. Kalyan is looking to divest its non-core assets. Titan is looking to grow through new categories, balance sheet improvement for players like PC Jewellers who have doubled in this year itself, and leadership transition for Titan sometime in the next year as well. Everything has a price. So let's look at it. 2 years ago, Titan was trading at 64 times, Kalyan 19 times, and Senco 13 times. 2 years later, after the underperformance, Titan is at 60 times, Kalyan is at 50 times, Senco at 29 times. So I guess what I'm saying is that the valuation differential has narrowed quite a bit. With this underperformance, is it time now for the street to remember the Titan?
Okay, interesting data that you've compiled there over Mangalam. Mihir, are you bullish on the jewelry stocks? Gold prices have inched up. Then there is that budget push with the customs duty cut. Consumers are lapping up. There is so much money to spend, right? It's going in real estate, it's going in stocks, and it's also going in jewelry. But he's put up a comparison
the most interesting data from Mangalam's piece was that Titan's valuations is at 60 times now, whereas the others have caught up very sharply in the last 2 years. Now Kalyan is quoting at 60 times, and Senco is around 40 odd times. So, what would you prefer in the jewelry space in case you have to buy something in that space? Will you stick with the leader?
So, a couple of things from the data that Mangalam presented. One is that it is a growth sector, right? So everybody is growing. It's not like one is growing at the expense of others. There is, as you rightly said, there is enough. The market is big enough and growing at a reasonable. It's a recession-proof industry. That's why it's always traded at a very high premium, because there's a lot of visibility of the top line. But now I think the industry has come to a certain size that there is space for more people, right? So the shift basically is not from one organized person to the another. It's from the unorganized to organized, and I think that will continue. So there is space for a lot of large players. That is one, and second is there is a difference in business models that the different companies are following. So there is a differentiation in terms of business model. While everybody is doing jewelry, everybody is doing studded versus gold, etc. There are certain differences in the way some companies are handling their franchises, some companies are owning their own shop. So I think that's also reflecting some of the valuations. If you, as you rightly pointed, the market is rewarding higher growth. So the narrowing of the premiums is because of the differential in growth rate, I would say.
So do you have any jewelry stocks in your
yes,
portfolio?
we do. I'm positive on the sector.
Oh, you're positive.
Sorry. Go ahead, Nima.
Yeah.
And what about on the other consumer sectors? Are you bullish on any part of the consumer discretionary or consumer staples segment?
So we have selected names. We actually have very few of the large cap FMCG stocks, frankly.
Okay.
Whatever we have in FMCG are very niche companies, which are...
What is niche?
Niche in the sense, for example, some snacking company, that company, some of the companies which supply to, say, kids, etc. So which are in segments which still have a long runway of growth, which is in line with our philosophy, that it should be a fast-growing sector or a fast-growing company with a long runway of growth.
Speaking of fast-growing companies, I just wanted your thoughts on Zomato and all the other platform companies. I mean, it's moved nearly 5 or 6 times from its recent lows itself, and now it's acquiring newer companies, it's acquiring newer platforms. District itself could be a next 22,000 crore opportunity for them in terms of valuation addition. What are your thoughts on Zomato?
So we've always been positive on platform companies, and as we during the NF also, this was one of the themes that we are pursuing, apart from the consumption and the financialization theme, infra theme, etc. Essentially, these are segments which are going to become oligopolies.
Okay.
It is a winner-take-all kind of a situation. So you'll have 2 or 3 or 4 players in each segment, and the total addressable market is anyway large. Plus, companies are going into adjacencies, so they can expand the TAM, by going into a newer category, which is what we are seeing in a lot of these cases. So we structurally remain positive.
Mir, a word on the luxury brand plays. Are you looking at that sector in a very strong way? Look at Ethos for example this week. At a record high, promoters sold out, and still, the funds are looking to buy into stocks like Ethos. In that luxury brand play, anything that strikes to you, which is still quoting at reasonable valuations?
So while we don't own any of those of this, but structurally the K-shape is still there. Right. So you are seeing much more resilient demand at the higher ends of all the consumption items, frankly. So I don't think that's a surprise.
So if again, just taking a name here, Stanley Lifestyles is the other one, which looks at a large total addressable market, which is the luxury furniture market. Again, the same thing that one would have looked at in the jewellery sector, say 20 years ago, where a large part is unorganized. There is one large organized player. Do you think there is a case for this shift here and underlying wealth creation? Not specifically this stock, but this sector?
Yeah. Only thing is, you'll also need to consider the particular segment, what the competition levels are. So some of the segments are prone to national monopolies or oligopolies. Some of the segments are anyway so fragmented that it may not be possible to make abnormal margins for a long period of time. So you need to analyze using that prism also.
Mihir, do stay on. We want to slip into a very short break, but we'll come back and talk about the mega block deal scene in this week. Stay tuned.
Well, this week was massive in terms of block deals in the stock market, and looks like it's only the PE investors and the promoters who are laughing their way to the bank. 20,000 crores is what we saw the block deal data for this week itself. The promoters and PEs have sold stake worth 20,000 crores. I'll start with this week, today's large block deals. The first large block was Ambuja Cements. 2.8% equity got sold today by promoters, and they've raised close to 4,250 crores. Tata Technologies did a block deal happen in the afternoon trade. Another 2.5% equity got changed hands there. A clean out trade there was, deal worth 1,000 crores. Nykaa saw another large block of 1.4% equity, a deal worth 800 crores, and GMR Airports also saw a large block of nearly 1% equity, deal worth 500 crores. So this was today's large block deals which happened in the market today. Similar was the case yesterday as well. Some large blocks happened in yesterday's trade. The biggest one was Kalyan Jewellers. 6.5% equity got changed hands. It was a clean out trade from PE investor. Vabok sold out completely, and that was worth close to 3,500 crores. The other large block deal was PNB Housing. In fact, PNB Housing saw two block deals in 2 days. Yesterday we saw 3.3% equity got changing hands. Asia Opportunities Fund sold, and that was worth close to 1,000 odd crores. The other big deals were, Eris Life saw a large block, nearly 7% equity got changing hands. Close to 1,200 crores of deal size was there as well. And so was Alchem Labs. The promoter sold close to 0.7%, and they raised close to 500 crores. So these were yesterday's large blocks. But as I said, PNB saw two large blocks this week. Even Wednesday, there was a large block, 5% equity got changed hands. General Atlantic sold, and they've raised close to 1,100 crores. And there was a large block in Zomato as well, where Ant Investment, they sold a large chunk and raised close to 5,400 crores. So, as I said, this week was large in terms of, large promoters and PEs selling stake, and they've raised close to 20,000 crores in 1 week itself. But as I understand, there's going to be more large blocks which are going to come in the days and months, in the days and weeks to come. So, looks like it's going to be an exciting week. Mir, what's your take? I saw your tweet as well. Despite so much of FI and DI buying, the markets have been not moved, but it's largely getting absorbed by these kind of blocks, right? Generally, how would you read the promoters and PE selling out?
See, at a price, there is going to be selling. Whether it's promoters or PE or VC, doesn't matter. There will be selling, and it's a natural process of the market. However, in the last week or so, as you rightly pointed out, there has been an accelerated amount of selling, which probably means that promoters are getting a little concerned about valuations, and then they think it's a good time to sell a little more, maybe buy a house or whatever.
So if you've been in the market for almost 3 decades now, generally who turns out to be right? The promoter who sells or the new investor who buys out?
see, small selling is fine. That's the normal amount of selling that promoters do. Yeah. But when you see concentrated selling, that may be a little, concerning, and time to be a little cautious, I would say. In the past, we never had PE funds selling in such a big way because we didn't have PE funds, right? Say 10, 20 years ago. But the quantity of inventory out there with the PE funds is huge. Yeah. So that is something that we need to be more cautious about. I would worry less about the promoters than the PE funds.
Okay, and PE funds obviously will, sell irrespective. Promoters can at least hold on for a longer time. PE funds have their cycles, etc. It also is telling of a market which is fairly buoyant on both the demand and the supply side. Not, either way. In a situation like this where promoters are selling, you're saying it's time to be cautious. How do you protect your capital? What do you do for you to stay above the water when everyone else is perhaps, drowning?
The first thing I would do is, never do is go down the quality curve.
Okay.
Because usually the lower quality stocks always optically appear cheaper. And there's a good amount of temptation to buy cheap stocks, so to say. But that never works in the long term, you know. And the second thing, especially in these markets, is to look at cash flows very closely. You know, people, it's fine in a normal market, you kind of ignore cash flows and all, it's fine because you're not really going down the cap curve. But as you go down the cap curve, as you go into a little less known company, I think the last 5-6 years of cash flows, working capital, fixed asset, those are the red flags, you know, one needs to look at. There are companies, you know, which have a very unbelievably low gross block, but suddenly have a lot of turnover. When, you know, yeah.
Mir, a word on the telecom. We saw a couple of reports today. AGM, Reliance AGM is going to be a key trigger to watch out. A couple of brokerages have raised the Geo's EPS estimates and numbers and all. Largely on the telecom side, what's your view? Is this a good consumption play?
It is actually, and probably the worst is over for the sector. Sure. And for the first time this year, we saw pricing hikes being taken by the leading companies. So, in my view, telecom will be a moderate growth, moderate return kind of a situation. Probably little better than FMCG, the large FMCG which are really into single digit kind of growth. Telecom may be a little better than that, but it may not be as high as say the financials, or so it's kind of somewhere in the middle.
What about aviation? Because you're talking about telecom, a lot of people believe that maybe aviation as well, you know, the worst is behind the sector right now. Going forward, the consolidation of power has happened with Interglobe Aviation, but there is at the same time the overhang of some supply coming in as well. How do you look at that one? So
aviation is one sector which I traditionally have been, you know, unable to put my, head around.
Okay.
And it's always been a sector where I think there's too much monitoring to be done in terms of, on one side you have the competition, of course, and the fuel prices. On the other side, you also have regulatory issues all coming up. So for me, it's always been a bit of a complicated sector. It's too much to monitor. So I have not really been, you know.
You'd rather fly than.
Yeah, I'd rather fly.
You said you're buying pharmaceutical names, select pharma names.
Yes.
Elaborate a little bit more.
So again, this is another sector where probably the worst is over in terms of,
and the earnings have been strong.
The earnings have been strong, and pharma is such an interesting sector because you get a lot of different plays. If you want a domestic play, you can get it. If you want an API play, you can get it. If you are an R&D play, you can get it. So there's a lot of choice in the pharma sector, depending on the comfort level. So we kind of mix and match and build a portfolio around that. Especially with a lot of other segments, which were earlier our favorite segments, having gone up so much, this seems to be a relatively better safe haven.
Mir, the entire PSU basket has seen some bit of correction now from the peak. A lot of stocks are down 15, 20, 30, 40% as well. And even the numbers have been quite mixed in the PSU basket. I actually reported last week, some of the companies have reported 1,000 basis points of EBITDA miss, those kind of numbers as well. Within the PSU basket, what's your take? Anything which is now turning attractive after the recent correction, and you feel like the numbers could come better going forward?
So in PSU, of course, it's a whole gambit of baskets from coal
defense
companies
or whatever, defense or
but our favorites or our exposure used to be in the defense space, and a little bit on the PSU banks space. So I don't think there's too much wrong going on the PSU bank space, and valuation's still okay, and stocks have corrected, so I think that looks fine. On the defense space also, while we did book a little bit of profit there, so we used to have a lot of exposure. Now we almost trimmed it down to less than half of what we used to have. But the stocks have corrected 20-30%, and I don't think the bigger picture has changed. Okay. So it's, I think, just a deferment of orders or a little bit of delay of the orders getting rolled out. But the big picture, if you 3 or 5 or 10-year picture, has not changed. I'm still bullish on the sector.
Mir, you said that it's time to be choosy and not cautious in the markets.
Yes.
Right, for a retail investor who invests via the SIP route, they want to go via the mutual fund. Which is the best? What's the best way? Should one be buying in, say, in a Nifty ETF or one of those equal weight, indices for the Nifty or the mid-cap index? Would you go down the sectoral curve? What would you recommend by way of purchase via an SIP route? But if you want to pick, a mutual fund.
So that would depend on your level of sophistication. So if you're just starting out in your journey of investing, probably you start with a flexi cap fund. But as you get more sophisticated...
But keeping the investing landscape right now in mind, the lofty valuations and where we are.
So if you look at pure valuations, I would say it's a barbell.
Yeah.
On one hand, the large caps are looking reasonably priced, but growth is not that great. But valuations have now come to reasonable levels. So that's the Nifty 50 basket for you, probably, maybe Nifty 100. On the other hand, I think the small cap space still offers a lot of exciting possibilities. And if you look at the aggregate valuations of the small cap index, it's at Nifty levels, at the large cap level. So given the growth adjusted equation, I would still say there's a lot more stock picking opportunity in the small cap. is the middle 150 stock, which is the mid cap, which is standing out in terms of expensive valuation. So that's, in my view, the expensive part of the market.
Right.
Okay.
No, just your weekend plan. What's that?
Weekend plan, I think, is to relax after so much activity.
All right, guys, this has been a great show. Thank you very much, Mihir, for coming down to our studio.
Always a pleasure. Thank
for our
you.
newsroom.
Thank you.
Well, with that, it's a wrap on this edition of Editors Roundtable from the entire team. Thank you for watching. You enjoy your weekend.